Today's episode of Market Talk is brought to you in part by GrowMark FS. Keeping up on the latest in ag is a challenge to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic grain and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. And good afternoon. Welcome into Market Talk for this Wednesday, November 3rd. Great to have you with us once again. I'm your host, Jesse Allen. Thanks for joining us, making us part of your day. MarketTalkAg.com is our home on the web. MarketTalkAg.com. That is where you can find us and get all the latest agriculture news, market information, listen to previous episodes, and much more. Oh, we saw a lot of broad-based selling today in these markets. Grains were down pretty hard, especially Minneapolis wheat, soybeans kind of led us in the sell-off here. But there's a lot of things to consider with the broad-based selling today. We got a lot to talk about. Let's bring in our good friend Mike Zuzolo, Global Commodity Analytics. Mike, good afternoon to you, sir. We broke our streak. We had a nice up day last week, and now we're back to a red here on this Wednesday. But there's a lot to unpack with what was going on today.
Yeah, we told them to bet on red last week when we said we were running 2 to 3 weeks higher, and that was not normal. So we knew the house was going to win here pretty soon, Jesse. Yeah, a lot going on. And I think, for me and what we're talking about this week, Jesse, ahead of the next WASDE report, I felt as though when you look at weather, whether it's South American weather or U.S. harvest weather, when you look at the crop report, and when you look at the Federal Reserve and the inflationary mindset, I think the Fed and the inflationary mindset is still much more dominant and much more important to me in reaching or not reaching price objectives and finishing up on 21 soybeans and moving to that next increment on 21 corn and starting on 22 soybeans. And so I was glad to see the Federal Reserve numbers and comments that are being put out right now as we go on air come out the way they did.
Well, let's talk about those comments. And obviously, those are just coming out here this afternoon. And I know that we've kind of been waiting to see what the Fed would do. Talk about some of the comments you've seen and what you've heard and what you've gathered from what we've got from the Fed here today.
Yeah, and I think one of the key elements before the Fed came out and to set the table a little bit is to frame it in the context of the Biden spending plans and infrastructure bills and everything in Washington that was going to increase inflationary pressures if it was put out, at least initially, I think, in the market's mindset. That had gone down, and Senator Manchin from West Virginia essentially shut that whole thing down before the Federal Reserve came out, and it gave the Federal Reserve probably about 24 hours to think about it. And I sincerely feel as though the fact that the Federal Reserve did not change their rhetoric and kept their inflationary term and definition as transitory, I think that was probably directly related to not seeing fresh fiscal stimulus from Washington, D.C. and from the Congress. And so I wrote that to clients last night, saying I felt like the pressure was off the Fed to have to do anything drastic, yet they would try and talk down inflation as much as they could. So I think I felt like I was half right. They came in with $15 billion of cuts on their mortgage-backed securities and also their bond buying, $10 billion coming off their bond buying, $5 billion a month coming off their mortgage-backed securities. So they're going to drop down from 120 billion a month down to 105 billion a month. But the key to me, Jesse, was they kept the word transitory, and the market reaction initially, at least, was new daily lows in the dollar index. And I do not believe in the transitory mindset, and I don't think the market believes in the transitory mindset at this point. So I would be encouraged to think that if the dollar remains contained, if not goes down, the trade's going to wind up for another bout of buying into the commodities and alternative assets with the idea that this is not going anywhere. And just one last thing to finish up on this point, Maersk, who is the largest container ship group in the world, said that they do not see any daylight whatsoever in this supply chain problem. And in fact, they bought an air freight company, so that they could get more of their freight out by air and air cargo even though the jet fuel prices are as high as they are. But that's how bad the supply chain is on the water. And I've told clients as of this past couple months and all the research I've done, you can't get away from inflation if you can't smooth out the supply chain. That's really where I'm at right now. And that's why I'm in that group that says that inflation is going to stick around for probably the first 6 months of 2022.
Well, Mike, as we look at some of the other factors as well, and obviously inflation, that's a big one, and we've seen it everywhere at the grocery store. We've seen it in our markets. We've seen these prices rally so much, and then now a bit of profit taking here the last couple of sessions, especially spring wheat, soybeans, corn to an extent as well. What do you make? It feels like a lot of people have been saying that this market got overbought really quickly. Do you feel like that's the case?
Well, I do and I don't. It depends on whether you're looking at the very short term or looking at the big picture. And what I talked about in the inflation is more of a big picture, the next couple, 3 months, taking us through the holidays and into the South American weather. I feel like, Jesse, when you look at the leaders to the upside, oats and spring wheat, that's where you were really sharply rallying on very light volume. I mean, the oats trade was like 400 contracts a day and some of these days. And so that's why oats are kind of like the bellies of the yesteryear. When I first started in the market, I was told from a CME pit boss for a major clearing firm, don't ever trade bellies, stay in the hogs, because unless you're up here with me and in the pits, you're going to get your head handed to you in the pork bellies because of the volume and only 3 or 4 traders trading it. And I think the oats are kind of the same way. They do tell you that the protein is in super high demand, so it makes sense that they were due for a correction. And so in that sense, yes, and they have been the leaders to the upside, and they've been the leaders to the downside this week. And what I like about the spring wheat and the oats technically is the September highs are now support, and we're checking those September highs heading into the Federal Reserve numbers and comments and policy. And we're also doing that ahead of the next WASDE report. And so those September highs, they could be support now. We could have another leg up in the markets. I don't know. But I mean, technically speaking, I think you put a lot of weight on those old monthly highs from September in both those two complexes. And if the dollar goes down and those old monthly highs from September hold, then we should be able to come back around in the other grains.
Well, let's look ahead to that WASDE report next week as well. And I know we're starting to get different private estimates out. I know you mentioned to me some Reuters numbers, Mike. I mean, looking at this, it sounds like a big crop's getting bigger, is what most everyone is pointing towards. Obviously, we'll wait for USDA confirmation on that. But one has to wonder, bigger crop, how's that going to play into some of our price moves here in the grain markets?
Yeah, I'm glad you brought that up, and I'm glad we got these numbers before we went on air, because I was really struck by what the average trade guesses were in this Reuters number. Wheat at 581, corn at 1.48 billion, so below 1.5, and soybeans at 362. Those numbers seem really low to me for average trade guesses, especially with people like StoneX and IHS Market pushing both the corn and the bean yields up in the case of IHS Market, and well above where the USDA was. I think StoneX is at like 51.9, if I remember correctly. Excuse me. Yeah, StoneX 51.9 on soybean yield, and IHS Market's the top end of those two at 178.7 on corn. And so that suggests well over a 1.6 carryover in corn and probably closer to a 375 carryover in beans. And so the question becomes, what is the demand number? If there's one thing that I care about next week when it comes to WASDE report, is how much demand have we rationed in the USDA's opinion. I really could care less about the supply side, because the supply side's tied up in whether these guys in the central and eastern corn belt get back in the fields or not. And I heard today guys are telling me, I said, hey, 6 days of dry weather here at this point, and many of them have said back to me, and they've been pretty sour about it. Look, 6 days of cold weather and dry weather gets me nowhere. I need 10 plus days in some cases, because some of these guys in Illinois on the flat black ground got 6 inches of rain. So I'm not real nervous about the supply side in the yield in terms of the corn and beans next week, because that number could fluctuate so dramatically based upon our harvest progress. It's the demand side that I think I'll really take note of.
Well, as well, we look at these markets overall, Mike, and before we shift to some other discussions, any thoughts here in the next couple of sessions? If we get a couple more corrective days tomorrow and Friday, down days, is there any reason for guys to panic? I know I've heard the chatter, you have as well. Just with some delays to harvest, there's guys out there that are starting to get a little frustrated, and they're maybe looking at their marketing plans pretty hard because they can't finish up the field. So, any thoughts for those guys and gals out there as they look at things this week?
Yeah, it gets a lot more easy. Gets a lot easier with 21 crop because you may not know what your yield is, but you know what it could be, and you know what your cost of production was, Jesse. And so I'm a really big fan of bought puts because if the harvest delays stay, your cash price should go even higher. Plus, you're not worrying about selling bushels you may not get out of the field. By the same token, those technicals that I was talking about earlier in the oats, in the spring wheat, in the crude oil market, these are our leaders to the upside. We don't want to just, walk away and whistle past the graveyard when these three commodities are going down and correcting, especially if there's a deeper correction. So I'm a really big fan of bought puts, especially ahead of the report on Tuesday. If we don't straighten this market out and fly back right and get back some gains as we get into Friday's close, I think it makes a lot of sense to do it that way because, again, what my put may cost me in a January bean put or a December corn put to get me through the report, I could, I think, more than offset with a basis improvement in the cash market if the weather stays wet and cold here in the United States. I think that's a really smart way to play it. And again, it goes back to you've got 200 plus potential yield in corn and a $5+ price. You don't want to walk away from that type of revenue per acre when you know what your cost of production was for 21.
Well, Mike, I want to talk about weather and the outlook there. And I know we're going to start putting a lot of emphasis on South American weather, but we're also going to be looking at the winter outlook here in the U.S. And I think you shared with me a map here. We'll pull it up on the video screen. And, thinking about just temperatures here this week, it's cold, it's rainy in some parts. We got some of the first frosts and freezes of the year. But looking at this map, to me, it looks like we're going to be looking above normal in many parts of the country through the winter months, and I wonder how that could affect us as we head into spring of 22.
Yeah, and this map I put out at midday with my commentary to clients and subscribers with the idea that this corresponded with a news report that Russia was going to start limiting their exports of fertilizer for the next 6 months. Earlier this week, the Ukraine had complained about Russia's Gazprom not sending them hardly anything, something like 1/4 or 1/5 of the normal poundage of natural gas through the pipelines for their businesses and for their winter heating needs. And it really seems to me that this fertilizer issue is not going to go away anytime soon. And that the market is now, because of this NOAA outlook that was done about 10 days ago now, is really banking on a warm November, which is what we're seeing, along with a warm December, which is incorporated in this map as well. And so I'm playing devil's advocate. I'm saying if we're going to stay tight on natural gas supplies and fertilizer supplies and we get cold and we get really cold and these maps are wrong, how are we going to handle that? And I think between that and the crop conditions in the winter wheat, Jesse, wheat's back in kind of pole position again to take us to the next level up. And I think that's what I'm really watching for because the winter wheat conditions came in at 45% good to excellent. More importantly, they came in at 21% very poor and poor. That compares to 19% a year ago. So we're already worse in very poor conditions in the winter wheat crop here in the United States than we were a year ago at this time. And guess where those areas were? Right where that blue area is in the Pacific Northwest. We're talking about like Washington State. Its crop conditions good to excellent were 33%. It was 58% a year ago. And the state of Idaho is even worse, where that's a big winter white wheat state. We're sitting at about roughly 41% good to excellent in Idaho wheat conditions. It was 62% a year ago. So I think this is where between natural gas, the energy markets, the fertilizer markets, and the wheat markets, this winter weather is going to be much, much more important than normal.
Very, very much so. And I think a lot to consider here as we head towards 2022. And a lot of guys are making those decisions on corn acres and bean acres and look at the cost of inputs. And there's a lot of decisions that are going to be made here in the next couple of weeks for sure. And then, of course, South America weather. I think that's another thing we have to keep in mind. They're having a pretty good start to their planting season down there. And that's something that's really, I think, going to take center stage probably along with the commodity inflation story here in the next couple of weeks, Mike.
Yeah, I'm glad you brought that up because they are a lot better off, both in Argentina and Brazil, given the last couple of weeks of moisture and just overall weather than they were, just 2 or 3 weeks ago. And, we were talking about maybe 3, 4 weeks ago how they didn't have certain levels in their lakes and in their reservoirs for water in some of these major cities in Brazil. That's being replenished now. And so the crops and the situation in Brazil, especially, is looking better. Argentina, wheat, Pampas regions looking better. There's some issues still, Jesse, that could rear their heads in January, February. But I think it really goes back to what you and I have been talking about. If we could just poke our heads above 1250 in the new crop November beans, I think you'd want to get quite a bit of business done there for the new crop hedges, because I don't think it's likely, but I think it's possible that we could have one of those years where the soybean demand from China isn't as good as it was back in 2020. And instead of $7.50 corn because of fertilizer prices, we're dealing with $9.50 soybeans. I think we really got to build a base case for that type of scenario. I'm not saying oversell your bushels on the cash side. I'm just saying lock in good profit. And I put an open order out for clients and subscribers to have out there in their first sales for 22 just this week. And I'll be babysitting that very, very carefully and closely here in the next 6, 7 days, especially once I see where we close this week and then where we're sitting in terms of U.S. harvest weather. The one thing we've got going for us right now is the spread, is the basis in the cash market. And if that holds up and stays strong, I have less worries about the new crop 22 beans. But if I'd see the spread start to collapse because we're going back to harvest, that would get me moving pretty quickly.
Mike, let's go to livestock today. We did see good strength there in that cattle market, hog market, not wanting to go down without a fight today as well. Seeing good cash trade and feedlot country here. Really just a strong, strong day. Probably attribute a lot of that to the cheaper feed prices, I'm sure. But talk about what you saw in cattle and hogs today, and walk us through some of that good strength we saw.
I agree with you. The cash price has been really good. The Texas Panhandle has been very active. Kansas has been very active, 2 to 4 higher in the Panhandle, $2 higher in Kansas. So we can call it 128 to 130 right now here at midweek. That's better than I thought it would be, Jesse. I thought this week would be a little bit more quiet week in the cattle market. It's nice to see this, especially given we're seeing weights start to build again on a dress basis consistently on the weekly numbers. I will say, having said that, I am nervous that the funds are coming in here and buying as well, because they typically dump out of their long positions in October, late October, early November, and then they come back in and start to buy again. At least that's what they did last year at this time. And I think between that, the futures cash premiums, and between the technicals that I'm looking at, I would say the funds are probably in this market as well, maybe a little bit harder than they're used to being if we go much higher. In other words, another $2 to $5 higher in the fat cattle and the feeders. I'll be back hedging because I feel like the funds are building too big of a long position, given the fact that I don't think the demand side is going to remain as strong given the high prices that we're dealing with in restaurants and grocery stores. And especially given that I've heard more recently of problems with packers maintaining their level of employment that they need to be able to kill what's necessary to meet demand. So I think the shackle space and the supply chain there is starting to get kinked up again, and I want to be ahead of that.
Well, Mike, any other final thoughts you have for us? We went through a lot here today. Before we run out of time, anything else you want to share today?
Just go to globalcomresearch.com and you sign up for a trial, because it's really worthwhile taking a look at the independent analysis I do. And if I'm not hitting what you want, that's where you can contact me directly and say, well, what about this? And I've actually had a couple new people sign up off of Market Talk. I appreciate that. And I appreciate them reaching out as well. So keep doing that. Go to globalcomresearch.com and take a look at what I can do for you.
Globalcomresearch.com. That is where you go to check it all out. Mike Zuzolo, appreciate the time as always. Have a great rest of your week, sir. We'll talk to you next Wednesday.
Thank you, Jesse, for having me as always.
Mike Zuzolo with Global Commodity Analytics. That's going to do it for the Wednesday, November 3rd edition of Market Talk. Find us at markettalkag.com. I'm Jesse Allen. Have a great afternoon.